Tax Structuring, Tax section of CFO100. When it comes to thinking about the large cost of your company, you may think of the purchase of goods, CapEx, and OpEx as the main items. Yes, business operation cost is indeed the key factor. However, you shouldn't forget the most important cost. It is tax cost. When you create new projects and companies, you need to consider deeply about tax efficiency and structuring. CFO needed to do optimization of group structure to reduce tax costs. There are three basic tax issues that you need to consider. If you touch the basic three items as tax perspective, the first one is dividend tax. The second one is tax on interest. And the third one is capital gain tax. Those are very important to consider the best structuring. And also, there are subtopics as additional tax issues. Those issues mainly include tax haven regulation impact, tax treaty effectiveness, and tax holiday. In addition to that, you should consider the accounting and cost points. Even though the country is the best for tax purposes, it sometimes has the problem of establishing a new entity. And if you establish the SPC for tax purposes, accounting closing work and the other administrative works may cause an additional burden. Moreover, there are other issues like investment and divestment flexibility, inviting other partners, and communication with local banks. Those points which you need to consider are very much number of things. As a package of the combination pros and cons analysis for those all points, you can determine the best structure for investment. Each country has its local regulation and tax rule. A tax treaty is different from country by country, so it is not so simple. CFO should ask each professionals to cooperate with each other to consider deep technical aspects. At least, CFO should understand the list of the issues in this page and instruct the accounting, tax, and legal divisions not to overlook any critical issues for structuring. You remember the above points in your mind and check the list to cover all the necessary items in your work. In this page, you can see example of how to make consideration of tax structuring as working level. The most practical way to do the optimization is to describe the potential structure as a picture and demonstrate the sample calculation. It gives a very clear comparison to you among several options. Tax consultant and their tax DD report are often shown in the same manner. You can catch the image of the analysis in this page. At the first step, you should consider the tax efficiency of the withholding tax on dividend or interest. The study is always conducted at the first and the most important part. In this sample, you invest in a company in China from your headquarters in the UK. The headquarters receives a dividend from the Chinese company. In this case, when the UK company receives the dividend, the company needs to pay withholding tax in China. In terms of CAT, the dividend from a foreign company is usually not recognized as taxable income because of UK domestic tax rule. So, the corporate income tax in the UK is zero. When it comes to considering the total amount of burden of tax, it is 15 million in this case. Let's look at the right side picture. It shows one intermediate company in Hong Kong. So the UK company invests in the intermediate company in Hong Kong. Then, their intermediate company in Hong Kong invests in the targeted company in China. At the time of receiving a dividend, the intermediate company receives money from the project company in China, and that intermediate company also pays a dividend to headquarters in the UK. If you calculate the taxable income for each company, there is withholding tax burden in China, but that burden and the tax rate depends on the tax treaty between the two countries. If the Hong Kong entity is eligible to use the tax treaty benefit of the Hong Kong-China tax treaty, the withholding tax rate is not 15%, but only 5%. How about withholding tax in the Hong Kong? There is another tax treaty also. Based on the tax treaty between Hong Kong and the UK, there is no withholding tax. In such a case, the total tax burden is only 5 million in this structure. It is smaller than the first case. This fact means that just putting the intermediate company between the headquarters and the project company gives you the benefit to reduce the burden of withholding tax. Of course, there are several rules for anti-abuse of using intermediate company just for reducing the tax burden. In this session, the detailed rules are not touched, but the concept is that you need to make a logic that you use the intermediate company, not so as a way to reduce the tax burden. You should have several specific reasons why you choose the country to establish the entity. As local tax rules and tax treaty rules are very complicated, your tax department and the business department discuss well to analyze the possibility to utilize the tax treaty benefit as much as possible to reduce the tax burden. Even if the nature of investment is good, the bad arrangement of tax structure causes unnecessary huge cost in the investment. I would like to explain the impact of the capital gain tax. As you see in the first slide, there are a lot of other points to consider for the best structure. Capital gain tax is a very hot topic among them that you need to pay attention to. So, you can see some examples of differences among tax structuring. The investment is coming from the UK to China. The left one is direct investment. On the other hand, there are intermediate companies in Hong Kong in the middle case and the right cases. Hong Kong is a famous place in which there is no capital gain tax. So your Hong Kong entity is not imposed on this tax. Considering this special treatment, you compare each case's tax efficiency. At the same manner as tax impact on dividend and interest, the best way to do the comparison is making a picture and a table for each cases and calculate the impact using numerical examples. You can utilize this methodology for many studies for other tax impact. In the left side of the scenario, you simply pay capital gain tax in the UK. In the middle case scenario, you don't pay tax in Hong Kong, but you pay the tax in the UK in the same manner as the first one. How about the third case? Your intermediate company in Hong Kong enjoys the benefit and doesn't need to pay tax in Hong Kong and the UK. That is because your UK entity has no relationship with this sales transaction, and Hong Kong entity enjoys Hong Kong's favorable rule for capital gain. By doing so, there are arrangements to enjoy the benefit of tax treaty to reduce tax burden. However, in reality, it is difficult to utilize this type of intermediate company benefit because there are other technical points of view to be considered. Especially for tax haven regulation, the UK tax authority may force the UK entity to aggregate the capital gain income generated in Hong Kong and to regard it as the taxable income for the UK company. And also, the Chinese government may force the Hong Kong company to pay capital gain tax in China, even though the subject entity is not a resident in China. Such local tax rule is difficult to understand for an outsider. You can catch the image of how each different structure has functioned as different tax implications in these examples. In real analysis, professional tax advisors compare several tax structures reflecting the detailed local rules. But the style of the analysis is the same as this lecture. Only the number of aspects is many as you can see in the first slide. If you see the specific comprehensive analysis, you can get a much clearer image of tax structuring study. Such kind of example will be explained in another lecture. The important thing is that you keep the discussion points in the first page in your mind and avoid any missed items in the study.